Come to the next paragraph, that is called reimbursement. Reimbursement who knows it better than a student? What is reimbursement? Some other entity will reimburse you the expense. Like for example, insurance company. Okay. If an entity will get reimbursement for all or part of the employee defined benefit liability by another party, like example, insurance company, you are paying for insurance premium for retirement benefit of employee, and normally the condition is that they will reimburse you when the employee will retire. The entity will recognize the right to reimbursement as a separate asset. Right to reimbursement will be recognized as a separate asset only if it is virtually certain to be received. In one more chapter, this had come, virtually certain to be received. IAS 37, reimbursement relating to certain provisions, such as qualifying insurance policy under which insurance proceeds will be used to settle the employee defined benefit liability. So some of the insurance companies have this now schemes where the company will have to pay the insurance premium, and when the employee retire, they will make you the payment, and out of which you can pay to the employee. However, but in case of defined benefit plan, if the insurance proceed is not adequate, then the employer will have to make good the shortfall, because it's a defined benefit plan. The entity will recognize the right to reimbursement at fair value, and it will be accounted for same as plan asset. So this is also accounted like a plan asset, because this is the amount out of which the settlement will be made to the employee. So either you manage or someone else is manage. Then next is asset ceiling. What is asset ceiling? This we have discussed in the calculation of net defined benefit liability in the SOFP. And this issue will arise when the fair value of plan asset is more than the present value of the defined benefit obligation. Okay. This issue will arise when the fair value of plan asset is more than the present value of defined benefit obligation. Now in that case, the standard applies the prudence. How much maximum asset can be shown to the extent of asset ceiling. And what do you mean by asset ceiling? The asset ceiling is the present value of refund available from plan asset or any adjustment allowed in future contribution. So we will take first the value in the statement of financial position, means asset minus liability. I had given one example, 120 minus 120, and then I will calculate the present value of any refund available from plan asset. Let us assume this is 16. So I will keep the value of the asset restricted to 16, net asset 16. And what about the remaining 4? The remaining 4 will be treated as a loss, and this loss will be recognized in OCI. That is asset ceiling. Now what will be shown in P&L account, what will be shown in OCI, and what will be shown in SOFP. SOFP I think we have discussed. SOFP we will show present value of defined benefit obligation minus fair value of plan asset. If fair value of plan asset is more, then it will be shown on the asset side as non-current asset subject to asset ceiling. In the P&L account, we will transfer the following items. 1. The current service cost, which we have discussed in 2 questions. Then past service cost. Past service cost is when a plan has been changed or introduced. Current service cost is for rendering services in the current year. And past service cost is the liability arising due to services already rendered in the past year, but there is a change in the scheme with retrospective effect, or a new scheme is introduced with retrospective effect. Okay. Point number C is determining the resulting gain or loss in case of curtailment or settlement. So one more thing we'll discuss below, curtailment. As you know, the meaning of this word curtailment means the benefit are reduced. Benefits are reduced maybe because a segment has been closed down, maybe the plan has been modified in such a manner that certain employees are no longer covered, or future benefits are no longer covered. So that is called curtailment. Curtailment can be with or without settlement. So at the time of curtailment, there can be gain or loss. That gain or loss due to curtailment or settlement will also be recognized in profit and loss account. And one more item, that is called net interest. Why it is net interest? We will calculate interest on opening obligation, that is my expense. We will calculate interest on opening plan asset also, that is my income. The net amount will be shown here, so it can be a net income or it can be a net expense also. Now here there is a difference between this standard and IGAP, Indian GAAP, Accounting Standard 15. In Accounting Standard 15, the interest on opening obligation is shown separately and the expected return on plan asset is shown separately. And both are measured using different rate of interest also. But here both will be measured using the same rate. Same discount rate will be used for calculating interest on liability and interest on asset. Net amount will be shown. So keep this number in mind because this will have an implication in OCI also. SOFP we have discussed. Let us revise. In SOFP will show the following item: net. Either the net defined benefit liability or net fair value plan asset, depending upon which is more. If liability is more than asset, net liability. If asset is more than liability, plan asset, net of liability. But in case of plan asset, we'll apply the concept of asset ceiling adjustment. This also you keep in mind because any adjustment relating to asset ceiling will be shown in OCI. Actuarial gain and loss will be shown in OCI. So now the question is, what are the items that we show in OCI? One, actuarial gain and loss. Second is now return on plan asset, excluding amount included in net interest on the net defined benefit liability or asset. Only this portion. Interest portion will go to P&L account. But difference between the return on plan asset and the interest income which has already been considered in net interest calculation, only that difference will be shown in OCI because it is calculated on the fair value of the plan asset. So it is the fair value at the end minus all adjustment, so that gives me total return. Out of this total return, what portion has already gone into P&L account in the form of interest? Exclude that, remaining amount will go to OCI. Like for example, suppose the return on plan asset is 100, but the interest on opening plan asset I have already recognized in P&L account, say 70. So what they will do now, this 30 will be shown in OCI. So this is the difference. Now next, what is the third item that we are going to show here? Any change in effect of asset ceiling. So OCI will have 3 items, P&L account 4 items. Yes, one student will answer, which are the 4 items in P&L account? P&L account, 4 items. Current service cost, past service cost, interest, net of interest income, net interest, okay, 4. Curtailment and settlement, gain or loss. 3 items in OCI, actuarial gain or loss, return on plan asset excluding the interest portion recognized in P&L account. And third is adjustment in asset ceiling. And these 3 items together is called remeasurement adjustment, okay, remeasurement, and this remeasurement is not subsequently transferred to P&L account. Now what is actuarial gain or loss? Actuarial gain or loss arises as a result of change in defined benefit obligation on account of change in actuarial assumptions. Example, demographic assumption, financial assumption. Demographic assumptions are related to mortality, employee turnover, disability and retirement, proportion of plan members who will be eligible for benefits, claim rates. And financial assumptions, basically financial items like discount rate, benefit, future salary, future medical cost, taxes, okay, salary growth rate, etc. Now the time has come to solve a question, but you have to write this question in the notebook. This question will help us to learn how to calculate actuarial gain or loss when there is a change in actuarial assumption. Normally such questions are not asked in the exam. You will ask why? Because that requires a lot of complicated calculation which is not in our domain as a professional student, but it is in the domain of actuaries. But still we will try to learn how do actuaries do this calculation, and this they have to do almost every year, because every year the assumptions would change. In the classroom environment we have solved 2 problems where we had kept things constant for 5 years or 7 years. In reality it may not remain constant for 5-7 years. And think about employees will retire after 30 years. Some assumptions will change, right? ASF Limited has defined benefit plan. ASF Limited has defined benefit plan payable after 6 years of service. You write payable at the end of 6 years of service. Otherwise unnecessary doubt. Payable at the end of 6 years of service. Payable at the end of 6 years of service. Amount payable will be 30% of last drawn salary. Amount payable will be 30% of last drawn salary for each year of service. The present salary is rupees 40,000 per month. The present salary is rupees 40,000 per month. Salary growth rate is equal to 8% per annum. This is my all original calculations in black font on the screen. Increased on the first day of the year. That means the salary will increase next year on the first day of that next year, and the discount rate is 10%. So you will say we have solved a similar problem today. Yes, you have, but only up to this. Suppose in year 4, Suppose in year 4, salary growth rate changes to 10%. Salary growth rate changes to 10%. And discount rate changes to 13%. And discount rate changes to 13%. Now they have added one question. Compute actuarial gain or loss. Compute actuarial gain or loss. Because of your change in two assumptions here. Which two assumptions we have changed? Salary growth rate at 8% is now you are assuming 10%. And salary growth discount rate was 13%, 10%. Now we are assuming 13%. So now what you'll have to do, you have to recalculate your liabilities using the revised variable. And then you have to see what I have already recognized and what I should have recognized. And that difference will go as actuarial gain or loss. So practically you can imagine this calculation they have to do almost every year and for so many employees. Okay. And that is why they charge a lot of fees. Prepare liability sheet for DBO and journalize. Now dear student, first you calculate the solve the problem as if there is no amendment. Start as usual. After 3 years only, in the 4th year we will know the assumption has changed. But the accountant will have to do the accounting, yes or no? For first 3 years as usual, business as usual, start little fast. Use both hands. Calculation of last drawn salary. Use left hand for calculator, right hand for writing. Calculation of last drawn salary. At the end of year 6. At the end of year 6. That is in bracket I have written original estimate. What is the salary given to you in the question? 40,000. If the person will retire at the end of year 6, for how many years he will enjoy the increment? 5 years. At 8%. So take on your calculator 40,000 into 1.08 to the power 5. That comes to, check again, is it 58773? Very good. This would be his last drawn salary, 58773. Then dear student, write point number step 2, calculation of projected benefit. Calculation of projected benefit. Under that 58773 into 30% into 6 years. 1,05,791. 1,05,791. Now this will be divided by 6. So step 3, calculation of allocated benefit. Benefit allocated per annum. Total divided by 6. 17632. Every year of service rendered makes him eligible to get 17632. Each unit, that means each year, generates an obligation of 17632 for the employer. So this will be payable at the end of year 6. Accounting will have to be done right from year 1. So we need the present value of current service cost. Step number 4. Calculation of current service cost. Calculation of current service cost. 4 columns on the right side, or you can just draw 3 columns if you want. Year, amount, present value. What is the original discount rate in the problem? 10%? Write present value at the rate of 10%. Then write down 1, 2, 3, 4, 5, 6. Write down the amount 17632. 6 times. 6 times. Now I will tell you a trick how to get it fast. Come to the last column. Start in reverse order. First write 17632. Press divide by 1.10 equal to. You will get 16027. Again press equal to. You will get 14564. Again equal to 13242. Again equal to 12043. Again equal to 10949. Okay. So this will save a lot of time if you learn the use of calculator. Start in reverse order. Keep dividing by 1.10. Now write down step 5. Liability sheet. Liability sheet. 6 years are there. 1, 2, 3, 4, 5, 6. Actually, you need not go for 5 and 6 also. You can stop. The reason is after 4 years, in the 4th year, the scheme or not the scheme, the assumption would change. Scheme is same. Actual assumption is changing. So liability sheet, year 1, opening obligation 0, interest 0, current service cost from previous table 10949, closing balance 10949. Is it right? Continue. Year 2, 10949, 10%, 1095. Current service cost 12043. Closing 24087. 24087. 24087. 10% of this 2409. 2409. Current service cost 13242. Check the calculation. And closing is 39738. 4th year. If assumptions would not have changed, this is what you would have done. 39738, 3974, 14564 and 58276. If you want, you can stop here, because I am going to prepare another set of table. Okay. So you will do the accounting of 3 years as per this table. And remember, my opening obligation of the 4th year as per the previous assumption is 39738. Done. Now journal entries I am not writing. Write journal entry homework. For the first 3 years, journal entry homework. Understood? So that journal entries you will do at the end once all calculations are done. Now write down step number 7. Sir, why 7? Why not 6? 6 was journal entries. Step 6, journal entries for first 3 years. Step 4, calculation of revised last drawn salary. Calculation of revised last drawn salary. Calculation of revised last drawn salary. Now how many years are over? 3 years are over. Salary will grow at the rate of what percentage now? 10%. We are in the year 4. Understand, we are in the year 4. And now we expect that this salary will grow at the rate of 10%. But not retrospectively, of course. From this point onward, for the future period. So first I will have to reach what is the salary at the in the fourth year. Salary in the fourth year. So salary in the fourth year will be 40,000 was the salary in the beginning, and the moment you reach the beginning of the fourth year, your salary gets revised. Your salary gets revised on the first day of the year. So in the fourth year, your salary will be 40,000 into 1.08 to the power 3, because it will get revised immediately at the beginning. Growth rate impact will take place for the fifth and the sixth year. Okay, now depending upon your interpretation, you can assume that the growth rate impact will come in the fourth year also, or you can say immediately in the beginning of the year the salary will get revised, and now they will revise the salary in future at 10%. So we will assume the growth rate of 10% will be effective of from fifth and sixth year. Up to 4 year enjoy 8% only. So what is your salary now? Angie? 50388. This is your salary at the end of year 4. Now estimate the last drawn salary. Step B, estimated salary in year 6. Estimated salary in year 6. The effect of that growth rate will be for fifth and sixth year. 50388 is at the in the fourth year. Fifth year salary will increase 10%, sixth year salary will increase 10%. So into 1.10 to the power 2. 60970. 60970. Now this is what my salary would be. So all my calculations are now going to be based on 60970. So now I will write down step number next. Calculation of revised projected benefit. Calculation of revised projected benefit. Calculation of revised projected benefit. Take this number now, because when the employee will retire, his salary would be this much. 30% of it is paid for 6 years of service rendered. So his total benefit would be on retirement 1,09,746. This we have to allocate over 6 years. Calculation of allocated benefit. Total divided by 6. Total divided by 6. Again divide by 6, not divide by 2 or 3. We are calculating what is actuarial gain or loss. So he will have to do the whole calculation again with this new number and check what should have been the balance and what is the balance. And the difference will become actuarial gain or loss. So 18261. Sorry, 18291, right? He will have to do this calculation all over again. And then you again do the same exercise. Calculation of revised current service cost. We are not going to pass the entry again for year 1, 2, 3. We are only going to pass the entry for the difference. But I need to know what was the balance and what should have been the balance. So start, shortcut. First you type 18291 in the 6th year. Divide by 1.13 equal to 16188. Again equal to 14322. Again equal to 12676. Again equal to 11212. Again equal to 9932. Okay. Start in reverse order. Type this number, divide by 1.13 equal to, if you press, you will start getting this number. Difference of 1 rupee, 2 rupees, okay. After this, you write down Revised liability sheet. Revised liability sheet. 1, 2, 3, 4, 5, 6 year. Do the calculation. We will not do the accounting of this interest and current service cost again. Don't worry. But at least I will get the balance. For 3 years you do the calculation. First 3 year compute the complete. First 3 years are over. Have you noted I have made a change in the format which you have not done? Actuarial gain and loss column also I have, or line also I have added. Right, one more column. First 3 year, check the answer. The last line check 9932 22435 and 38028. Is it there? Have you reached 38028? Now next year, I will write two numbers here for understanding. 38028 also write and 39738. In my books, which figure is appearing? In my book, which figure is appearing? 39738. In my books of account, 38028 is not appearing. So you just take a pencil and show, no, my actual figure in my books is 39738. This is book figure. This is what it should have been. Okay. And now I will calculate the interest. On which number I will calculate? On this number only. This year my interest charge will be 38028 into 13%. How much is that? Write in bracket, otherwise you may wonder what is this. My interest calculation will be at the new rate because in 4th year the estimates have been revised with respect to discount rate, and it should have been now 38028 into 13%. So this interest we will charge. Current service cost I have already calculated. Current service cost I have already calculated. Okay. And what should be my closing obligation? Now you see, I have to change my liability from 39738 to 38028. So can you just tell me what is the difference between the two? Is it 1710? Yes. So closing obligation should be 57294. Closing obligation should be 57294. So if suppose in the exam this figure is normally given, normally this chart is not required by the student so far. This figure they will give you, and then you will have to find out the actuarial gain or loss. So then actuarial gain or loss will be the balancing figure if this figure is given to you. Okay. So this year we will have to recognize one actuarial gain or loss which have arisen due to two reasons. One is change in salary growth rate estimation and one is change in the discount rate estimation. So that give rise to a difference between what we are showing in the books and what will be the closing obligation as per the new assumptions, and that difference goes to actuarial gain and loss. Next 2 year is again simple. Continue. Start with this number and complete the table. Check the answer of the next 2 years. 57294, take 13%. 7448. Current service cost we have already got it, 16188. 0 80930. 80930. 80930 into 13%, 10521. 10521. And then you write 18291, 0. What is the total? 109742. Okay. Is it matching with that calculation that we had done? Some difference would be there, but that is okay, because you are actually going to pass entry on the basis of these numbers only. One more homework. Journal entries. So what is the journal entry you'll pass in the 4th year? In the 4th year, I will pass entries like this. First is interest cost account debit, current service cost account debit, to present value of defined benefit obligation. One more entry. Present value of defined benefit obligation to actuarial gain in bracket OCI. And here I will write in bracket P&L account, P&L account. You want to write? No. Understood. Interest cost account debit, current service cost account debit to present value of defined benefit obligation, and then present value of defined benefit obligation to actuarial gain in bracket OCI. And this 2 year will be same. When the employee will retire, you will make this amount of payment. Okay. Now we'll come to past service cost and curtailment. Come to your notes. Past service cost and curtailment. What is the meaning of past service cost? It means increase or decrease. It can be decrease also in the present value of defined benefit obligation, either due to introduction of a new scheme with retrospective effect or modification or amendment to an existing scheme from retrospective effect. Why it is called past service cost? It is the cost for the services already rendered in the past. Current service cost is the cost for rendering service in the current period. Now here my cost is going up, but for the service which have already been rendered in the past. Like for example, in the previous question we said the gratuity will be 30% of last drawn salary. What if they say now it will be 40% of last drawn salary instead of 30%? Possible? Employee will be happy. But this is not a change in actuarial assumption. It is a change in the plan only. So this is past service cost. It can be the gratuity will be 20% of last drawn salary. So in that case my liability will decrease. Okay. So that is why in your notes somewhere I have written it may be positive or negative. It may be a cost, but in rare case it may be a gain also for the enterprise if the past service cost reduces my obligation. And then what is curtailment? Curtailment is the change in liability due to reduction in future benefits that the employee was supposed to get. Either the number of employee gets reduced or some element of future benefits are reduced. This usually happens when there is some kind of restructuring or change in the law. business segment may be closed, department may be closed, okay, change in law, etc., may make some employees not eligible for future benefit, may reduce the number of employees who are eligible for the benefits. So what is the accounting treatment for this? They have simplified in this standard compared to IGAP. IGAP means Indian GAAP. What we follow in India under AS 15, that past service cost will be divided first into two categories, vested and unvested. Vested means those who have completed the desired number of year of service, and unvested means those who are yet to complete the desired number of year of service. Those who have completed is called vested in AS 15 is charged to P&L account, and those who have not completed is unvested is deferred and recognized over the remaining vesting period. Good news, all past service cost, vested or unvested, will be charged to P&L account. Okay, so we don't have to now keep a track of vested, unvested, and then writing of the deferred past service cost here. These are costs that arise in the measurement of defined benefit obligation due to change in existing plan or introduction of a new plan. These costs relate to service already rendered by the employees. That is why the term past service cost. Past service costs are recognized as expense, underline, in the period in which they are incurred. It is the change, and how do you compute it? Again, for the student, this calculation is not asked. But if they ask you, then again you have to do the revised calculation from retrospective effect. See what is your liability now, what would be the liability if I go by the new plan. Okay, the difference between the two is your past service cost. So again you have to prepare a fresh liability sheet as per the new scheme. Reach that point where the scheme has changed, compute the difference, and that is your past service cost. But in none of the exams or in any of the study material anywhere, normally this question is asked for calculation of past service cost. This figure is provided to you. Good news. It is a change in the present value of defined benefit liability in respect of previous year services of employee resulting from amendment into the plan or curtailment. It may be positive or negative. Past service cost is classified into vested past service cost and non-vested past service cost. But for accounting purpose, there is no difference. Both will be recognized in profit and loss account only. It will be recognized immediately in the profit or loss as an expense when the entity makes announcement and becomes liable for it. So this way they have simplified the accounting treatment of past service cost. Past service cost do not include difference between actual and assumed salary obligation, change in estimate of constructive obligation, change due to actuarial assumption, and where the vesting is complete. What is curtailment? What is the meaning of curtailment that you know? Reduction in future earnable benefit of employee. Reduction in future earnable benefit of the employee. It arises when the entity amends the plan in such a manner that future services of employee will earn no benefit or low benefit, such as, for example, significant reduction in number of employees, discontinuation of a business segment, sale of a business line, etc. Curtailment may be of two types. One is curtailment with settlement. Curtailment with settlement. What is settlement? That will give you a lump sum amount and you give up your right to all future benefits. Okay. So this is also possible. Take all future benefits in one lump sum amount, shake hand and tata bye bye forever. Okay. So in this case, what we will do, we will calculate the gain or loss. How do we calculate? It is when future benefit of employee is curtailed and vested benefit will be paid off immediately. In such case, now see the calculation which they will not ask you to calculate. It is provided to you. The difference between PV of defined benefit liability settled. So this is my book value and settlement value. This is what I paid. So book value and what I paid will be charged to statement of profit and loss. Okay. So book value may be 30 lakh and employee may be given 35 lakh. Take 5 lakh more, 5 lakh will be my loss. Gain also is possible. Curtailment without settlement. Now here I am not paying him anything. He will be eligible for all future benefit that is entitled to him. Only my liability amount will get reduced because it will be based on revised figures now. So it is when future benefit of employee is curtailed, but vested benefit of the employee will be paid at original maturity date. In such a case, the difference between A and B will be charged to SOPL. A, your present value of defined benefit liability and fair value of plan asset before curtailment, and the present value of the defined benefit liability and fair value plan asset considering curtailment. This figure is already there in your books. Do the revised calculation with curtailment and the difference between A and B will be your gain or loss. Mostly gain only because it is curtailment. Now solve this simple question number 15. Answer is not printed. Oh, printed. Okay. 16, 17 not printed. So a pension plan of a company provides a pension of 1.5% of final salary for each year of service. The benefits are vested after 4 years of service. However, on 1st January, the company changes the pension to 1.25% of final salary for each year of service starting from 1st January 2019. The present value of the differential benefit for services from 1st January 19 to 1st January at the date of change are as follows. Employee with more than 4 years of service 125 and employees with less than 4 years of service on an average period until vesting is 4 years is 121. So total is 246. 125 has vested, 121 is not yet vested. But for the accounting, it will not make any difference here. Determine the amount recognized in respect of past service cost. So you will transfer entire 246 to SOPL. That's it. One line only. The enterprise recognizes the whole amount of PSC of rupees, what is PSC, past service cost, of rupees 2,46,000 immediately. Since IAS 19 state that past service costs are to be recognized immediately. So we don't have to differentiate between the vested or unvested past service cost. Now dear student, come to question number 16. Oh, answer not there. An enterprise discontinues a business segment and the employee of this segment will earn no further benefit. This is a curtailment but without settlement. Means we are not paying him anything. So what I need to do? I need to revise my calculations. And difference between a previous calculation and revised calculation will be recognized in P&L account. So the standard says the curtailment reduces the obligation to 900. Suggest accounting treatment immediately before curtailment. The details were. Now see, the present value of the obligation before curtailment is 1000. After curtailment, the obligation is 900. What about the fair value of plan asset? It will remain 820 only. But this is altogether a different thing. This is investment. So investment will remain 820 unless something else is given in question. So what is the accounting treatment? Reduce the liability by 100. Write down journal entry. Present value of defined benefit obligation account debit 100. Just one entry. PV of defined benefit obligation account 100 to P&L account to profit and loss account 100. That's it. So what will be the new presentation in the SOFP? Now the new presentation will be in SOFP liability 900, asset 820, net liability 80. Net liability 80. Same question. 100% same question with lot of stories. So they convert into case studies like this, okay? And you will find that questions 16 and 17 are actually same. Now 17. Rockstar discontinues a business segment. Under the agreement with the employees union, the employees of the discontinued segment will earn no further benefit. This is a curtailment because employees will continue to receive benefits for services rendered before discontinuation of business segment. Curtailment reduces the gross obligation for various reasons, including change in actuarial assumptions made before curtailment. In this, if the benefits are determined based on the last pay drawn by the employees, the gross obligation reduces because now all your assumptions will change after the curtailment because the last pay earlier assumed remains no longer valid. Assume the following. Immediately before the curtailment, based on current actuarial assumption, the gross obligation was 6,000, fair value of plan asset 5100. Curtailment reduces the obligation by 600, which is 10% of the gross obligation. They have given both figure. This was actually not required, which is 10% of gross obligation. They could have written curtailment reduces the obligation by 10% of gross obligation. Anyway, they are helpful institute. Calculate the gain from curtailment. 600, the answer is printed in the book only. And the liability after curtailment. So liability will be 5400 and the net liability will be 5400 minus 5100 in the balance sheet. So first write down gain on curtailment equal to 600. There is no calculation required also because the amount is also printed. Then write down gross liability after curtailment. Gross obligation after curtailment 6,000 minus 600, 5,400. Then write down net liability after curtailment. Net liability after curtailment 5,400 minus 5,100 equal to 300. That's it. So what is the difference in the two questions? No difference. They have converted a simple problem into a case study. Now we will curtail our today's lecture. Okay. Tomorrow